Welcome to the Deep Dive, the show where we unpack complex topics to give you the clearest, most actionable insights.
Great to be here.
So for many of you who follow economic news, the Federal Reserve is, always there in the background. But how much you really know about it, beyond the interest rate headlines?
Yeah, it's a fantastic question. Because the Fed has this immense power, right? It influences interest rates, employment, the whole economy, really.
But it stays kind of mysterious for a lot of people.
Exactly. So our mission in this deep dive is to pull out the key insights from our sources. We want to help you understand this powerful entity, its surprising independence, and, well, the constant debate about how Congress keeps tabs on it.
Okay, so we're talking about an institution that, yes, Congress technically supervises, but it has a remarkable amount of freedom.
Yeah.
How does that actually work? How is it insulated?
Well, it starts right at the very top with the Board of Governors. They're protected from being fired unless it's for cause. Serious stuff like incompetence or breaking the law.
Not just because a politician disagrees with them.
Precisely. And maybe even more importantly, its budget isn't decided by Congress each year. It funds itself mostly from interest earned on the securities it holds.
Self-funded, okay.
Yeah. And the original idea behind all this insulation was basically to shield financial policy from short-term political games.
Right, trying to keep politics out of monetary decisions. Sounds good in theory.
Right.
But doesn't that create a fundamental tension?
Absolutely. That's the crux of it. You have this ideal, right, an independent Fed making tough, maybe unpopular, long-term choices without worrying about the next election cycle. But then you have the need for democratic accountability. How do you balance that independence with real oversight from Congress, especially, when things get rough, like in a crisis, and the Fed suddenly has enormous power?
That's the core question we're diving into.
Exactly.
Okay, let's unpack this structure then. Our sources call the Fed a hybrid public-private setup. That sounds unique. What does that mean in practice?
It really is unique. It was a compromise born back in the early 20th century, trying to balance the interests of private banks with the government's need for a central control over the money supply.
So how does that play out? You mentioned the Board of Governors.
Right. 7 members, appointed by the president, confirmed by the Senate, and they get these really long, staggered 14-year terms.
For 2 years. That's a long time in politics.
It absolutely is. And that term length, plus the for-cause removal thing, really shields them, makes it very hard to push them out for political reasons. And crucially, no elected officials or current administration members can be on the board. Another layer of insulation.
Okay, so that's the public side, appointed and confirmed. What about the private part? The regional Federal Reserve banks. That's where it gets a bit fuzzy for some people, right?
It is, because these 12 regional banks are technically privately owned by the commercial banks in their district. Those member banks have to hold stock in their regional Fed.
Ah, so the banks own the Fed. I hear that sometimes.
Well, that's where perception and reality kind of diverge. Yes, they hold stock, but the sources say this ownership is mostly symbolic today. Member banks don't really control the Fed like shareholders control a company.
They don't get profits like normal shareholders.
They get a fixed statutory dividend. But, and this is key, all the net earnings of these regional banks, after their expenses and that small dividend, go straight to the U.S. Treasury.
Oh, okay. So it's not like the banks are pocketing huge profits from the Fed system itself.
Not directly, no. But this structure, this historical artifact of private ownership, it does fuel a lot of misunderstanding and, frankly, criticism about whose interests the Fed really serves.
I can definitely see that.
Yeah.
And our sources point to a specific criticism here that financial executives tend to dominate the boards of these regional banks.
That's a recurring point, yeah.
And that this might give them an outsized role in picking the regional bank presidents who are pretty influential figures. Some sources even mention how many current regional presidents are, like Goldman Sachs alumni.
Right, which immediately raises flags about potential conflicts of interest, or at least the appearance of them. It's a constant point in the oversight debate.
Definitely seems like fuel for critics. But, okay, Congress does have some oversight tools.
Yeah.
It's not a total free-for-all?
No, absolutely not. You've got the Senate confirmation process for governors. That's a big one. And Congress sets the big picture goals. Maximum employment, stable prices. Those are in the law.
But they leave the how to the Fed.
Generally, yes. The idea is Congress sets the mandate, and the Fed's experts figure out the best way to achieve it using monetary policy tools.
And they have to report back, don't they? Testify and things like that.
They do. The Fed chair testifies regularly, twice a year usually, before committees in the House and Senate. big public hearings. Plus, the Fed publishes detailed financial statements. You can see exactly which securities it owns.
Okay, transparency there. What about audits? Can someone like the GAO, the Government Accountability Office, go in and check their books?
Yes, but with a really important exception. The GAO can audit a lot of the Fed's operations. Check processing, handling currency, their buildings, things like that. Operational efficiency, waste, fraud.
Well, there's always a but.
The big but is that the GAO is legally prohibited from auditing monetary policy deliberations.
Oh, so they can't look into why the Fed decided to raise or lower interest rates.
Exactly. Or their discussions about transactions with foreign central banks or governments. Those core policy decisions, the reasoning behind them, the debates, those are shielded from GAO review.
And that seems particularly relevant when we talk about crises, right? Because that's when the Fed's power really expands dramatically.
Precisely. During emergencies like the 2008 crash or the COVID pandemic, the Fed uses its emergency powers, Section 13.3 of the Federal Reserve Act.
What does that let them do exactly?
Basically, it allows them to lend money quickly to a much wider range of borrowers than usual, often with a less direct, immediate congressional say-so. They can set up special lending facilities, basically step in where private credit markets freeze up.
And that's where the criticism really ramps up, especially from, say, a more conservative, limited government perspective.
Definitely. You hear lawmakers like Senator Toomey arguing strongly that the Fed shouldn't be doing things that look like fiscal policy, picking winners and losers, allocating credit. They say that's Congress's job, the job of elected officials, not unelected central bankers.
And the sources mention significant criticism that the Fed might have abused this emergency power without enough oversight.
Yes, the argument is that they acted too broadly, maybe without enough accountability. And beyond just the emergency powers, there's broader criticism, too.
Like what?
Well, some argue the Fed's general policies keeping rates low for long periods, buying up massive amounts of bonds, what's called quantitative easing, or QE,
Right.
that these policies actually create problems, like asset bubbles, driving up stock prices or housing prices unsustainably, or causing inflation. Some critics even claim these policies worsened the conditions leading to the 2008 crisis and primarily bailed out Wall Street, not Main Street.
That criticism definitely has a long history. It's not just a recent thing.
Yeah.
Our sources mention figures like Louis McFadden way back in the 1930s.
Oh, yeah, he was a House banking chairman who gave this incredibly fiery speech accusing the Fed of deliberately causing the Great Depression, called them moneyed vultures. Really intense stuff.
Wow. Okay. Maybe not that intense today, but that skepticism clearly lives on.
It does. You see it in the modern and the Fed movement, which really gains steam with Republican Congressman Ron Paul.
Right. He was known for constantly introducing bills to audit the Fed or even abolish it completely.
Exactly. His core argument, which his son, Senator Rand Paul, has echoed, is basically that the Fed itself is the problem, that it destabilizes the economy, causes inflation, and that we'd be better off with a free market monetary system, whatever that might look like.
And that viewpoint has translated into actual legislative proposals from conservatives, right? Like the FORM Act.
Yes, the FORM Act passed the Republican House back in 2015, though it died in the Senate. It aimed for more transparency, things like cost-benefit analyses for new Fed rules, reports on international negotiations.
And trying to limit those emergency lending powers.
Critically, yes. Trying to rein in how the Fed could use Section 13.3. Other proposals have floated ideas like a commission to review monetary policy, or even making the Fed get its budget approved by Congress like other agencies.
Taking away that self-funding aspect.
Exactly. And some Republican senators pushed to release the transcripts of the policy meetings, the FOMC meetings, faster after 3 years instead of 5. Just trying to get more sunlight in more quickly.
So faced with all these calls for more oversight, more transparency, how does the Fed respond? What's their defense for keeping things the way they are?
Their main argument consistently is that too much transparency, too much political meddling could actually backfire. It could politicize the institution, as they put it.
How so?
They worry that if monetary policy decisions get tangled up in short-term political debates, it could spook investors and actually make the policy less effective. They fear decisions might be made to please politicians facing re-election rather than what's best for the economy long-term.
And former Chair Janet Yellen made this point explicitly.
She did. She directly opposed broader GAO audits, arguing they'd bring short-term political pressures into the Fed's private deliberations. She also pushed back against ideas like public comment periods for international talks or mandatory cost-benefit analyses, saying they'd just bog the Fed down and undermine its necessary independence.
Is there evidence to back up that claim, that independence leads to better policy?
Well, they point to academic studies. Scholars, they say, have shown quantitatively that central banks tend to be more effective at controlling inflation when they're more insulated from political pressure.
So it's a real debate with arguments on both sides.
Absolutely. And while some of the really old criticisms about total secrecy might be outdated now, like the Fed does publish its balance sheet weekly, it is audited for waste and fraud.
Right.
That fundamental tension, that philosophical difference about independence versus accountability, it's still very much alive.
It definitely seems like a dynamic that shifts. You mentioned the CARES Act during the pandemic that did impose some new oversight, right?
It did. It was a direct response to the Fed using those emergency powers. The CARES Act specifically required the Fed to report data on who got loans and the terms. And it set up new oversight bodies like the Pandemic Response Accountability Committee and a Congressional Oversight Commission, specifically to watch over that emergency spending.
So even when the Fed acts decisively in a crisis, Congress often follows up demanding more transparency after the fact.
It shows that balance is constantly being renegotiated, especially after major events.
Okay, so wrapping this up, it's really clear the Federal Reserve sits in this unique, almost precarious spot. Public goals, some private structures, designed for independence.
But facing constant pressure, especially from conservatives in recent years, for more accountability, particularly when it flexes its muscles during crises.
Striking that right balance between independence and congressional oversight seems like it's going to be a challenge for a long time to come.
It really will. And it leaves a big question for you, the listener, to think about. How much political influence is too much for the institution managing the nation's financial stability?
And, maybe more personally, what could it mean for your economic future if that balance tips too far one way or the other? Something to definitely chew on as we look at the future of economic policy and, really, the role of powerful, unelected bodies in our democracy.